Mike, under anybody that is, looking at the situation closely at all, a recession compared to those last times you were on looks much more likely, and maybe even like it could be a worse recession than we factored in last couple of times you were on. Is that where you are?
Yeah, Joe, as you know, we're very focused on earnings. Earnings are dependent on the economy, obviously. We think it's unavoidable to avoid a earnings recession, and that's what matters for stocks. I would say for the bond market, interestingly, rates have been continuing to go up, and this idea that the economy is holding together, right? That's going to keep the Fed hiking. The jobs market is still strong, and that's true. We showed it in our note this week. Economic surprise data has actually been to the upside lately. And until that rolls over, right, and we really see like the PMIs in the 40s, and we see, maybe jobless claims spiking to a level that would indicate, we're going to have a true unemployment recession, then bond yields will hold up. And then once those go down and the dollar peaks, then you can probably form the bottom for equities. But it's all interrelated, right? Whether it's earnings, whether it's the economy, we're in a cyclical downturn for growth. And that's the fire and ice narrative to a T, right? The tightening policy into the slowing growth. And we're just not finished yet in our estimation.
Right. There's a lot in front of us that's not a surprise. So the case can be made that there's a lot of what you just talked about that are in some of these prices already. We've had a terrible year so far. And then the only other thing I would say is, if you believe maybe that the job market has some different characteristics than in the past, and that the damage to other parts of the economy that could be much worse than we know about right now. Consumers seem like they're not feeling as good. Mortgage rates suddenly are 6%. This employment picture might look surprisingly strong, and there's wage issues there and sticky inflation. But we've had some guests on recently that said the economy is in much worse shape right now than people realize.
Well, yeah, I think that's right, because you think about real wages, they're still negative. The consumer's getting, or the employee is getting a better wage now, but they're still having trouble keeping up with prices. That's where we are. It's a difficult setup. Now, here's a scenario that I think could be different this time, Joe, that we have to consider, which is, companies are having a hard time finding employees this time because of the shortages in labor, which we think are somewhat structural because of the pandemic.
Right.
And what we may see that happen, where the employees, don't get laid off this time, even though companies see margin pressure because companies are so loath to lay people off. They want to hang on to their good employees. And that means the margin pressure could be worse this time. And those structural changes, I think, are going to take a while to kind of work themselves out. And that's another risk to our earnings story that we think, whether there's a recession or not, because you can have a situation where you don't get an employment cycle, but the earnings recession is actually worse than if you just had a normal recession. Mm-hmm. So just a lot of moving parts. And look, I would feel a lot better, Joe, if the equity risk premium were at 400, 500 basis points, but it's just not. We're 260, 270. You're just not getting paid to take equity like risk, particularly when a 1-year T-bill is at 4%.